All right, today is Thursday, September 3rd, and this is a post-market review for the stock market activities today. We have a lot to discuss today. Obviously, it was a huge day in the stock market, so this is the agenda for today. We have important discussions, specifically in the options market discussion. So if you're not going to watch this video at all, make sure that you watch and you hear discussion about the options market. And here we go. The Dow Industrial Average closing in the red, a decline of 807.77 points, or a decline of 2.78%. The Nasdaq getting whacked, down almost 600 points, or 5%. The S&P 500 down 125.78 points, or 3.51 percentage decline. Moving on to the sector's performance, everything was in the red today. Everything is lagging, and we have no medals to give to any sector. However, leading the decliners, tech, consumer cyclicals, and communication services. And moving on to the futures market performance, we see OJ, Palladium, and Lean Hogs closing in the green. However, lumbar getting whacked today along with stocks. Sugar down, coca down, corn down, coffee, silver, platinum, in addition to crude closing in the red as well. So bad to the stock market and a bad day in the futures market as well. And now, shifting to the big casino, the gambler's market, and perhaps the most important topic of the day. If you've been watching this channel, you know that we've had this discussion before. The stock market is not rallying on organic buying. It is rallying on fake buying and on the action of the options market alone. And this is exactly what happens when the gamblers invade the stock market and take control. You will see the impulsive move to the upside, and then the impulsive move and the crash to the downside. So what happened specifically from a technical perspective? For the last few weeks, we've been tracking the action in the options market. We've been saying the volume in stocks have been declining, have been very muted, but the volume in the options market has been skyrocketing to insane levels. And what happened the last few weeks is a phenomenon called gamma squeeze. The market rallied not because market participants are believing in Tesla or Apple or Nvidia or any of that garbage. The market rallied on a shaky stool called gamma squeeze. In a gamma squeeze, what happens is the options market is invaded by gamblers. In this case, it is the Robin Hoodiots, the gamblers and the amateur traders who use Robinhood and other platforms who recently invaded the market, and they think if they bet in calls and they buy calls every day, not knowing what the stock, the underlying stock is, and not knowing any technical or valuation analysis or anything, just zombie traders programmed on autopilot buying of stocks and call options. They get a bunch of tickers from the morons they're following on TikTok in the morning. They buy calls on these tickers. They don't even know what the companies do, what they are. And what happened is, because they are gamblers, they buy out of the money weekly calls. For example, and this is hypothetical, let's say that Facebook is trading at $300 a share. The Robin Hoodiots and the gamblers invade the market and they buy the 330 weekly call expiring for that specific week for the strike price of 330. When there is a huge influx of gamblers and a huge influx of volume buying the 330 call, well, somebody has to write these calls for them and sell the calls for them. And what happens is the writers of the options say, oh, these guys are a bunch of fools. They're betting that the stock is going to rally 10% in a week. What are they thinking? This is easy money. But because the sheer volume of the stampede on the 330 strike call, some options writers hedge by buying the stock first and then selling the 330 call. And when that accumulates and snowballs, where option riders are buying the stock one by one and the 330 strike volume explodes, Facebook stocks start moving higher and higher. And what happened is, as it get close to the end of the week, the expiration week, and closer to the strike price of 330, option riders who did not hedge and buy the stock ahead of time, they scramble, they panic, and they start buying the stock and stampede to hedge because they don't want to go to expiration date and deliver the shares at a loss. They want to buy it ahead of time so they can make a little bit of profit if they can when these options are exercised, or at least minimize their loss by buying the stock before it increases way beyond 330. So you see this explosion in volume and buying of the stock, and you see stocks rally impulsively. In this case, Facebook, the example that we've been using right now. So for that particular given week, the gamblers and the Robin Hoodiots win. They score big. They bought out of the money call, the 330, which is unrealistic. They bought it for very cheap, and now they scored big. They made insane profit, and they do that next week and the week after. And now they're rolling in cash, they're scoring big, they figured out the easy way to make money. You buy out of money, call options, and what do you know? Stocks rally impulsively to the upside and you make insane amount of cash. This is the story of the stock market for the last 3 to 4 weeks. Now, do you think that options riders who scrambled to buy the stock to cover their asses for selling the option are really interested in holding the stock? No, they're not. I mean, they sold a call option to begin with. They were not believing that the stock will move higher. And now let's say a few weeks passed, the Robin Hoodiots and the gamblers scored really, really big. And they're gambling on the same names: Apple, Tesla, Facebook. So now options riders have accumulated huge amount of stock, meaning that for this particular week, they can write the call options out of the money and they don't have to hedge because they have enough stock positions that they've accumulated in the last few weeks while getting their asses kicked. Now they're looking for revenge. They're looking to trap these moron Robin Hoodiots into a big, massive trap. So what do? On Monday this week, Tuesday, and even yesterday and Wednesday, the gamblers did what they've been doing for the last few weeks, buying out of the money call options expiring this week on the same names: Apple, Tesla, Facebook, etc. Now, these options riders are watching the show and they're having a big bag of popcorn because they're about to score big and they're about to slaughter these morons once and for all. They suck them in Monday, Tuesday, Wednesday. They let them buy all these out of the money options calls. And what they do is today, as you've seen, they dump all these shares that they've been holding for the last few weeks. And they create the cascade down effect, the waterfall, and all the gamblers who bought weekly call options are now dead and slaughtered. Option riders get the last laugh. This is exactly what happened when a gamma squeeze fires back and bites the gamblers back in the ass. You've seen what happened today. The media is confused. CNBC, if you've been watching today, they're confused. There's no catalyst. There's no catalyst for the reversal today. What happened? How can we explain it? There's a reason to explain it, and I just did it. It is technical, related to the options market action. And now when you see a sell-off and you see these option riders dumping all these shares, they trigger algos. Algos been hibernating for the majority of summer. They haven't been triggered by a sell-off. And now that the sell-off started, algos are triggered and they amplify the movement to the downside. And the Robin Hoodiots are now introduced to a new thing in the market called algos. They've been saying, oh, don't fight the Fed. It's not related to the Fed, you morons. The stock market is going up due to gambling. And if you want to talk about don't fight the Fed, don't fight the algos. The algos are more powerful than the Fed in the short term. So did the gamblers learn the lesson today? No, they did not. They reverted back to what they've been doing for the last few weeks. Gamblers do what gamblers do. Check out the options market today. Number one, Apple at 3.6 million options traded. And I bet that the majority of these options sold today expiring tomorrow. 61.5% are calls. And at number two, Tesla, 1.48 million options traded today. 55% are calls. And at number three, Bank of America with about 824,000 options traded. 67% of those are calls. Do these morons think that they're going to create a gamma squeeze tomorrow? No, that's not going to happen. Option riders still have plenty of stocks to dump tomorrow and the week after, creating more and more sell-off. And if you didn't know why the market was acting the way it did today, now you know. And keep in mind this lesson: the house always win. If you're gambling, if you don't know what you're doing, and you're scored by the fool's errand and by dumb money being lucky money for the time being, hit the sell button, take your money, and get the hell out of the stock market, because you will get slaughtered like every gamble ends. The gambler gets slaughtered and they lose all their money. The house always win. Trust me, I worked in Las Vegas casino industry for years. I saw my fair share of gamblers. They come to me and they say, look at us, we've turned 20 grand to 200 grand to 2 million. And I say to them, brother, you haven't made anything unless you take that cash and you get the hell out of that city. Because if you don't, you're going to keep coming back and coming back until you lose it all, and the house always wins. Enough said. Now moving to the heat map analysis. And it was a tsunami of red, a sea of red, all sectors, nothing spared. However, some names fared better, specifically laggards. Laggards outperformed, and when we say outperformed, we mean that they didn't flush to the downside as some of the high-flying names did. Case in point, we talked about this yesterday. Take a look at Intel stock. It outperformed Nvidia and AMD and the rest of the semiconductor sector because it's already been whacked. So watch for Intel to continue to outperform and perhaps start trading in the green in the days to come. And now let's switch to the heat map of the ETF market, and you can see everything is red here. Exception, of course, are the bear funds and the inverse funds. They performed very well today. The bearish funds owned the day today. And now, moving on to the headlines that shaped the day. We don't have a lot of headlines today, but we have important ones. The first one, of course, was the weekly unemployment or jobless claims. It came out at 881,000 applying for unemployment benefits or for jobless claims for the week that they've been counted. And of course, the media had a massive orgasm about the number. They're talking about a recovery because it's not over 1 million like last week. But the devil, of course, is always in the details, and don't count on them to do the job and show you the truth of the matter. This is why you watch the Maverick of Wall Street. So here's what happened. When you scroll at the report, you will see that over 2.5 million people applied for pandemic unemployment assistance in a matter of week. 1 week difference. And you have over 2.5 million in 1 week applying for unemployment. You think that's not going to show up in tomorrow's big jobs report? Unless they cook that job report, and they better hire good chefs, it could be abysmal. And of course, the next bit of news that we got in the morning today is the ISM Services Index, and it came out as 56.9 versus 57 expected. That is still a decline from the prior month, and we are a services-oriented economy. And if we're not seeing a recovery in the services sector, then how the hell will the economy ever recover? And now let's move on to the charts analysis. We have very important charts to look at. Starting with the SPY, the S&P 500. Here's a 50 minutes chart. There's nothing to see here. It is a big gap down and a flush all the way to the closing bell. However, when we switch to the daily chart, the first thing that catches your eye is the put to calls ratio. It is starting to pick up, and that is not good for the market. And of course, you see the RSI reversing. We talked about the overextension in the RSI and other indicators, and you see it is reversing. And when you go to the weekly chart, you see that the MACD is curling down and is showing a reversal. And here is the overall picture, the big picture. This is a trend line that goes all the way back to the 2009 bottom of the financial crisis. We have visited this trend line periodically and bounced from it. You bet that in a big correction, we will come back and visit this trend line again. That is the healthy way to do it. And I know a lot of technical analysts have been talking about this megaphone pattern. I don't know about a megaphone pattern, whether that's true or not. But I know that this is a major trend line, perhaps the most important trend line in the chart of the SPY, and you gotta visit it at some point. And now moving on to the triple Qs, the Nasdaq, the technology sector. Right away, we go to the 15 minutes chart. What did we say yesterday? A potential of a double top. Here is your double top. A bear flag. Here is your bear flag. When you combine that with the extended RSI and the divergence from the daily chart trend line, which we're going to talk about in a second, the pieces of puzzle come together, and you don't have to be a genius to predict a severe pullback, and we saw that happen today. And now the flush that we saw today from a 15 minutes perspective could have the potential of creating another bear flag and a continuation of this negative move. And now, of course, shifting to the daily chart, and here's the divergence. You can see all the divergences from this trend line that goes all the way back to April. We talked about this line the last few days, and we said it's not healthy, that the Qs are diverging so far from it. It is a recipe for a steep correction. The higher you diverge, the steeper the correction. You saw what happened today. So the trend line is a target, minimum target of the correction. Giving the impulsive move, don't be surprised if we pierce below it. And here is the weekly chart of the Qs. You can see the MACD, it's still positive, it's still extended, but it's starting to curl down after today's movement. We're going to see if there is a continuation of that direction or not. And you see the RSI was way overextended, and it is pulling back and correcting. And of course, if you want to short the triple Qs, you can buy puts on the Qs, or you can short the index directly. But here is a slide I made of other tickers that you can use to short the Qs. These are inverse tickers, so you buy them or you buy call options on them, and I ranked them by volatility, and I'm showing you the level of spiciness in it. The short triple Q, the S triple Q, for example, is the extra spicy one because it moves with very high and extreme volatility, up and down. And I say, if you don't have the stomach for big moves, then you should consider buying spicy or mild instead. Because the short triple Q you've seen today moved almost over 10%, over 14%, but it's been declining big. When the Nasdaq rallies, the short triple Qs will be down significantly. So don't hop in the ride unless you have the stomach for volatility. And speaking of volatility, let's switch to the VIX. Here is a daily chart of the VIX, up 26.46%. It is an explosion to the upside. We've anticipated this. We've been talking about it. And here it is, the movement right in front of you. Switching to the weekly chart, we've been saying now for the last few days and perhaps weeks, we're waiting for the MACD cross from a weekly perspective in the VIX, crossing the blue line, the average, and making green impressions in the chart. Doing that would be very bullish for the VIX and extremely negative for the stock market. Don't expect the VIX just to peak in the MACD line to the green territory and then come back down. No. That's not how it's going to work. It's going to explode further to the upside, meaning more pain to the stock market. And now let's move to the SMH, the semiconductor sector, because it is an important component of the overall technology picture. And it got whacked severely today because you saw names like Intel, AMD, Taiwan, and Lam Research, and the rest of them taking a very severe whack on the head. And the significant here, the technical significance, is the breakage of the channel. We broke the lower end support of the channel that goes all the way back to the bottom in March 2020. This is very negative, and I tweeted about this, said it's very negative for the semiconductor industry and the tech sector overall, because you don't break support for a channel that goes all the way back and you say, hey, it's no biggie, we're just going to recover and bounce back. Doesn't work that way. We have a severe decline ahead of us in the semiconductor sector at least. And of course, the big kahuna, the biggest stock in the world, Apple. And the most important, of course, remember, if you've been a follower of my work, you know that I've been saying, as Apple and Tesla go, so will the market. What did we see yesterday? Apple and Tesla breaking, and what do you know? The market broke with them. Here is the daily chart, and right away your eyes go to the price to sales ratio in the blue chart right there. Did anybody think that this is rational or sustainable? That a large company like Apple has an extended out of whack price to sales ratio in the valuation? Absolutely not. At least I didn't, but some of the gambling crowd, of course, don't expect them to know about these ratios and technical analysis. They're zombified traders. They get the ticker, they click the call, they buy the call strike, and that's it. They have no knowledge, no clue about how the stock market operates. And of course, when you look at the weekly chart of Apple, big reversal, and check out the RSI. Again, if you've been following me, you know I've been eyeing this level in the RSI, and I said if Apple hits this level, expect a reversal, and I would be shorting Apple at that level. What do you know? To the penny. Exactly to the penny, Apple reverses, and what do you know? Does the Maverick of Wall Street knows what he's talking about or not? And now let's move on to Tesla, the other momentum name and the other part of the puzzle. I tweeted in the morning illustrating the levels of support, potential support in Tesla, and I said if you are shorting or if you have put options, consider closing your positions when Tesla hits these levels, because it will bounce and it will create some support, at least at the moment. And of course, the level of support was the 405. That was the most important level today. And if we switch to the 15 minutes perspective, you will see that Tesla caught support from this level not once, not twice, not three times, over and over and over again. And of course, said in a tweet, if we pierce through the 305, it's going to create a domino effect. You're going to see a severe sell-off and a flush down in Tesla's shares. So they better rescue the stock before it flushes down. What do you know? At the end of the day, the stock actually pierced through the 405 support for a little bit, but it was rescued right away. And that was very important. And perhaps the silver lining here that Tesla closed the day at the support. But if we see a breakage of that support tomorrow, good night, Irene. You gotta wait till the next support and perhaps the one after for Tesla to stop the bleeding. And now let's switch to the rotation trade. Let's see the contrast between the high-flying names that have been benefiting from the pandemic environment versus the laggard names that got hurt due to the pandemic environment. We're tracking a rotation in anticipation of the vaccine. We're switching from winners to losers. So was this rotation theory validated today? I would argue yes. Because on one hand, both sectors got whacked today, closing in the red, but the magnitude of the drop, the names, the comeback stocks on your right-hand side was minimal, and some names managed to close in the green actually. Meanwhile, looking at the left-hand side, the momentum stocks that we call garbage stocks now because they're overvalued and overextended, and we want to rotate from them. We want to use them as the ATM, take the cash, move it to the laggards. They got whacked pretty hard today, and that is very significant because I said nibble on the comeback stocks. Don't go all in, because I want to see how these stocks perform in an overall correction scenario where the market get hit, every index, no exception. And you saw that they performed better. They performed and exceeded my expectations. Now, this is not an invitation to go ahead and go like a drunken sailor and shop and buy all these names. This is not what I'm doing. I'm still nibbling. I want to see another day, perhaps a week of a big sell-off in the market. I want to see how these names will stand and weather the storm. Are they going to continue to bleed slightly, or will they eventually flush down just like the names on your left-hand side? Or will they actually outperform and manage to close to the green? And that would be your evidence that the rotation is real, and it happened. The momentum names were used as ATM, and now they're moving the money and rotating it to the laggards and the names that got hurt by the lockdowns. So we're waiting and anticipating the validation of that rotation. However, what I did today, of course, is I started nibbling more, adding to my positions little by little, taking advantage of some of the names that dropped, and of course adding to my shorts in the names that you see on your left hand side. And now let's conclude this video. An important day, a massive day. We have few takeouts from what happened. But first, let's remember this. I've been saying to you, to all the gamblers and the Robinhoodians who have been impulsively gambling by buying weekly call options, I said, look, this game is gonna work and it'll be fun while it lasts. You're gonna make a lot of money, but you haven't made anything unless you hit the cha-ching button, the sell button, and you cash your gains. Otherwise, you will also ride the ride to the downside. You rode it high, you will ride it low, and you watch all your gains disappear. And the market is not gonna come knocking at your door telling you, excuse me, sir, tomorrow's gonna be the reversal day, or next week's gonna be the reversal day. Please consider taking your profits, buying some puts, and hedging your positions. It doesn't work that way. It works that you become so arrogant and so indulged in the gambling, you become overconfident. What happened is you wake up someday and they pull the rug during the futures. The market flushes down as you saw today. When the market opened, it continues to go down and the pain continues and you watch your gains disappear. And of course, you're not going to have the discipline at that moment to realize that the show's over, sell, take your gains, and get the hell out of there. No, no, no. What you're going to do, like you've seen in the options market today, is gamble further and think that this is a dip worth buying. We'll see how that will work. And that leads me to the next point, which is psychology. Let's take a look at the psychology of the longs and the amateur investors that invaded the market and have been scoring big for the last few weeks and the last few months. They have the recency bias. They've seen dips before and flush downs in the market back in June and again in July. And all of these flushes, granted, were smaller than the flush today, but there were opportunity to buy. The market continued to recover and march higher. Stocks only go up. This is their motto. So the recency bias is, hey, this is another dip. We're going to stampede again. We're going to do what we've been doing before, buying call options and buying the dip. So if you're shorting the market, now this is your psychology, you have to be aware of two things. Number one, you are traumatized because it's been really bad for you the last few weeks and the last few months. So what you're going to do is you're going to short or buy put options. You're going to make a small gain. You're going to panic and close it right away because you're traumatized and you're not sure that the movement will continue. You're afraid that they're going to rally the market tomorrow. So you book your gains, and you've seen a little bit of that happening at the end of the day with the short covering. They've been waiting and waiting and waiting, and finally when the market moves their way, they panic and they act scared like a bunch of chickens, and they take their profits right away, small profits. The market is moving your way now, but be cautious and careful and disciplined. On one hand, don't panic. Close your positions too early. Watch the technicals, follow the psychology, and time your entry and your exits properly. On the other hand, you have to be aware of the psychology of the other side. They're going to stampede to buy the dip at some point. Maybe not tomorrow, but perhaps next week. So again, anticipate that the dip will be bought and we will see a reversal. So you have to have the management and the discipline not to close your trades too early where you miss on gains because you panic, and also not to leave them overextended because the reversals and the reaction from buying the dip would be as impulsive and as severe as the movement to the downside. Now, remember, there's an outsider that will be thrown to that mix. It's not just the longs versus the shorts. At some point, if the pain continues and we see that the market flushed down tomorrow, and after Labor Day, we see the Dow losing more than 500 all the way to 1,000 points every day, understand that Congress will panic and all of a sudden they will feel the urgency to pass the stimulus. They didn't feel the urgency of passing the stimulus when we know that over over 30 million Americans didn't have enough to eat last month, but they will feel the urgency to pass the stimulus once the stock market crashes. So keep that in mind. Injecting new stimulus to the market will mean a recovery for stocks, at least in the short term. So time your shorting position, get out when you need to, perhaps play the rebound when you see it, buy call options. This is all options right now. You don't commit large amount of capital and risk because it's going to be extremely volatile. The point of options is to reduce capital, reduce risk rather. So you shouldn't commit a lot of capital when you commit any options trades. That is for gamblers, of course. So we will do that, buying put options, playing the flush to the downside. When it reached important technical support, we will close these positions, take profit, and perhaps buy some calls to catch the profit from the rebound and take it one day at a time. The market will be very volatile, up and down, and you don't want to commit a large amount of capital. What you want to do is, at least what I'm doing, is accumulating little by little in the comeback stocks because the vaccine will be announced before the election. You've seen multiple indications to that effect. So we're going to accumulate positions in the comeback stocks and play the volatility via options, up and down. Now, the last thing, of course, we do have the jobs report tomorrow. And this is the take here. We could have a surprise to the upside due to the reopening of dining and restaurants in the leisure industry. I live in Southern California, so I'm speaking about my experience. Going outside, restaurants have outdoors seating right now, and they have good capacity outside. Restaurants are packed, bars are packed, and they're busy. They're rehiring waiters, bartenders, cooks. So that could show in the jobs report. However, the take is this. What happens if the situation continues and we reach the winter month where you cannot have outdoor dining, at least in the northern part of the country? These job gains will reverse and we will lose them again. So you want to see a jobs report where the job gains are not just in the restaurant and hospitality industry. You want to see job gains in the services industry, construction, education, healthcare. If we just see a good employment number, but the majority of that number are waiters and cooks and bartenders, I'm not going to buy it. I am going to fade. I know that the media is going to have a massive orgasm and perhaps the algos will kick in and the market will start to rally because the number is quote unquote better than expected. But when you do the devil in the details, if we don't see a surge of hiring in construction, education, the other important sectors, and if we see more furloughs turning into permanent job losses, you bet that I would be fading the rally. And I think the market will come to its senses and would reverse whatever gains that happened right after the announcement of the results of the job report. This is just one scenario to keep in mind. We could have an upside surprise, but you do have to look in the details. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.